So, with all the craziness going on this year, especially with the global health issue that has convinced so many countries around the world to lock down and really destroy their economies, there's been this looming fear in the market that if things were to get worse, then maybe the stock market might be headed down either through a correction or maybe even a bigger crash, kind of like what we saw earlier in the year. Now, I'm not saying that's what's going to happen. In fact, there's been some positive news recently about multiple V-shot candidates that seem to be effective in treating the pepperoni. And if that's the case, then maybe we don't have lockdowns and things just kind of gradually get better. Either way, though, if things were to happen to get worse or just for a number of other reasons, I think it's always important, it's always a good idea to have a list of great stocks that you like that you can keep an eye on and be ready to buy if their prices were to come down. And so, because of that, we created a new series on the channel where we talk about every single month, we do a new episode and we talk about 3 stocks that I think would be great buys if their prices were to drop for any number of reasons. And to make things a little more fun and interesting, we separate these 3 stocks into 3 separate categories. So we pick one core foundational stock that is a safer long-term play with a business that is very likely to recover from any kind of struggles or a crash or anything else and can still be successful into the future. Then we choose one kind of middle of the road type of stock, maybe a little riskier, but still has a lot of promise and future potential, maybe a little more exciting of a company. So maybe the valuation is a little high, but if you can get it when the price comes down, then that might be a good buying opportunity for it. And then we finally pick a dividend stock because we all know that when the stock market goes down and prices come down, dividend yields go up. So anytime that there's like a market dip or correction or crash, picking up a dividend stock or multiple can be, great buying opportunities. Those can be solid buys. So we're going to talk about those 3 in today's video. This is our 3rd episode so far. I hope you guys enjoy this. This is a fun series. I enjoy doing it for you guys. Hit the like button if you are enjoying it. But with that said, we got a lot to cover. So let's start with our stock number 1, and that's going to be our core foundational stock of the month. And this time I decided to go with a little bit of an underdog at the moment, and that's going to be Disney. Ticker symbol is DIS. And the reason why is because if the global health issue gets worse and even more lockdowns are implemented, Disney would likely be one of the most heavily impacted companies out there, and that could lead to an amazing buying opportunity. In fact, back when the lockdown started earlier this year, Disney stock took an absolute nosedive, falling all the way down to less than $80 a share, which was almost a 50% fall from their all-time high. And even though the stock has mostly recovered from that crash, it's still only up around 20% in the past 5 years, which isn't a whole lot. So any big drop from these current levels, I think, would be a great buying opportunity for the long term. That's because Disney has too much brand strength and a strong competitive moat that makes it virtually impossible for them to not perform well in the future. In fact, when looking at their new streaming service, Disney Plus, which is one of the biggest reasons why the stock is still trading as high as it is, they were estimating to reach 60 to 90 million subscribers by 2024. Here's a screenshot showing that from their first reveal event. And not only have they been on track to meet those expectations, but they pretty much already achieved it many years early. In Disney's very first year here in 2020, Disney Plus's first year, I should say, they've already surpassed over 70 million subscribers. That's insane. At this pace, it's not crazy to think that they might even catch up to Netflix over the next few years, considering how well the service markets to not just adults, but especially kids, making their target audience and addressable market that much larger. But speaking of adults, Disney also has 2 other streaming services that target those demographics even better with Hulu and ESPN Plus. And because you can bundle all 3 for a cheaper price, it appears that the success of Disney Plus is already spilling over into those products as well. Over the past year, ESPN Plus has nearly tripled its subscriber count, while Hulu was able to grow by close to 30% as well. And despite Hulu only having around half the number of subscribers than Disney Plus, they actually generate more than double the amount of revenue because their services are higher priced, especially their live TV add-on, which even during the era of cable TV cord cutting, it actually grew its subscribers by over 40% year over year as an alternative option. So I just really think that people are kind of brushing Hulu off way too much because there's actually a lot of potential there. Anyway, add to that the most box office market share thanks to all the big budget movies that Disney produces that can, by the way, also fuel their streaming platforms with even more contents that they don't even have to pay licensing fees for because they produce them themselves. And then you add on also the gigantic theme parks and resorts that people are addicted to, and they're always kind of willing to pay huge ticket prices to enjoy them. And you've actually got a pretty well diversified company with popular brands that can even be licensed out to other stuff too, like video games, for example. It's just a solidly built long term business. The only problem with Disney right now is that the pepperoni has really forced movie theaters, theme parks, and even Disney cruises to either shut down or operate at much smaller capacities, and that's really bleeding the company right now. In fact, Disneyland in California has still not opened to this day. That's pretty crazy. Anyway, the damage has been so great that 2020 was the first year that I can even think of in an extremely long time that Disney actually reported a loss on the bottom line. I don't even think that happened during the Great Recession. In fact, it was so bad that operating income fell by 45% for the year, although it did still manage to stay positive somehow. And given all the hurdles, the fact that revenues only declined by 6% in the full year is actually pretty impressive. And over the next couple years, they're already expected to return to high growth as much as 17% in 2022 alone, probably because of all the pent-up demand that is likely building up. Anyway, times are tough right now, there's no doubt about that, and if more lockdowns come, then expect Disney stock to take much more damage. But management has proven that they can keep the business stable enough even through the most catastrophic events, so buying the stock on another large drop I really think would be a no-brainer. In fact, I'd likely be adding to my position as well. Okay, now moving on to stock number 2. That's going to be our kind of middle of the road type of stock. A lot riskier, but still very interesting with a lot of future potential. And for this one, we're going to go with a more speculative biotech company that is a major player in the DNA sequencing market, and that's going to be Illumina, ticker symbol ILMN. And if you're not familiar with what this is, DNA sequencing is expected by many to play one of the biggest roles in the future of healthcare. What it does is, through the use of various systems, it scans and maps and analyzes DNA variations and functions to solve problems related to things like cancer cell mutations or even genetic diseases, so that they can be treated in much more personalized and effective ways. And Illumina is one of the companies that develops and manufactures these systems while also providing analytical and testing services as well. This is a big deal as the market will likely become very large in the future. In fact, in a recent Forbes article entitled "Genomic Stocks Are in the First Inning of a Multi-Year Megatrend," they noted that it's easily the most overlooked megatrend that is revolutionizing healthcare with trillions of dollars on the line, and they went as far as to predict that huge gains are on the horizon. Well, the good thing about Illumina is that it's easily the market leader in that over 90% of all the sequencing data in the entire world is actually generated from Illumina systems. Needless to say that if the market becomes as large as it's expected to, Illumina will be one of the biggest beneficiaries. Unfortunately, we're still in the early stages of this trend taking shape, and therefore it's been, and will likely continue to be for some time, a bumpy ride. Illumina has experienced large gains at times, like 18% revenue growth in 2018, but this year they're actually falling by close to 10% before being expected to return to high growth the year after. It's not a huge surprise though, this year has been very hard on many healthcare related stocks as people just aren't going to hospitals unless they have the pepperoni, and even then most people just stay home. In fact, many hospitals have actually gone bankrupt. Just by June alone, that list had included over 40 hospitals in just the United States. Not to mention that the economy has been absolutely destroyed, and it doesn't help that genome sequencing is very expensive. Granted, that price has been coming down dramatically over the years. Back in 2010, the cost per genome was massive at around $15,000, but today it's only a few hundred, so it's much more accessible to the average person. However, the systems and the services that Illumina offers are still very pricey, and hospitals are not in great shape to be paying for them. Still, even with these hardships and volatility, Illumina is one of the few companies in the space that is actually profitable and with decent margins too, considering how new and expensive this market is. Plus, there's lots of reasons to be optimistic about the future, including a huge 15-year cancer sequencing partnership with Roche announced around the start of this year, launches of new sequencing products, and even a big acquisition that they just announced a few months ago of Grail, who is a developer of Galleri, which is a multi-cancer screening test that an earlier version of was able to detect over 50 different cancer types, over 45 of which have no recommended screening in the US. In other words, it's a super young market that hasn't really been tapped into yet. In fact, Illumina CEO recently said that the oncology testing market is expected to grow at a compound annual growth rate of close to 30% through 2035, eventually reaching as much as $75 billion. Currently, he notes that Illumina's addressable market is only $15 billion, so this could be a major growth driver for them in the future. Unfortunately, Grail is not a profitable company, which will mean even less earnings for Illumina, and thus the stock has been performing poorly recently, currently sitting at around the midpoint of their 52-week range after going through some pretty volatile swings. But even with the recent drop, the stock is still trading north of a 45 forward PE ratio, which is obviously considered to be very expensive. But that's kind of the point of this video. If there's a market drop or crash, then that price will come down, and that'll make this a very attractive stock with lots of future potential. Yes, it's risky. Yes, I do consider it to be quite a bit speculative, but this is a company that operates in a market that I think will only get larger in the future, and they happen to be the market leader in it. And so if I am going to be picking up any kind of speculative stocks, those are the ones that I like to bet on. In fact, I'm actually thinking about picking up this stock myself, even around these prices. I'll have to update you guys on that. I'll let you know if I did end up deciding to buy it. But so far, I've kind of been liking what I've been seeing, and I'm thinking about just buying a little bit and maybe just adding to it over time if it continues to fall. But especially if the price goes down from here, I do think this is a decent stock to be keeping an eye on. Okay, and finally, it's time to finish up the video with our dividend stock of the month. And for this one, you guys know that I often talk about AT&T as one of my favorite and largest dividend investments, and some people actually get mad at me because I talk about them way too much. So this month, we're actually going to switch it up, and we're going to go with one of their rivals that I practically never talk about on the channel, but is actually a pretty good long-term dividend stock because of utility-like income that helps them pay large dividends, and that is of course Verizon, ticker symbol VZ. And just like AT&T, Verizon benefits from growth in markets that we can all agree will only get larger in the future, and that is internet use, which is crucial for practically everything these days: artificial intelligence, Internet of Things, gaming, streaming, data center, business, working from home, the list goes on. And then there's also wireless telecommunications, with more and more people using smartphones, and of course the rise of 5G only fueling that growth even further. And Verizon is in a prime position to benefit from all of that, as they're consistently ranked the best amongst their competitors across their various products and services. When looking at internet, Verizon's broadband and fiber optic network, referred to as Verizon Fios, was ranked number one by JD Power for each of the past 7 years in a row in overall customer satisfaction as an internet service, with PC Magazine also granting them the Choice Award in each of the past 12 years in a row, with a number one ranking in reliability and speed, as well as the highest likelihood of customers recommending it to friends and family over the competition. And growth continues to pour in for internet, as in their last quarter, they were able to gain almost another 140,000 Fios additions, which was up from only 30,000 the year prior. And if you combine their business internet customers, they saw a net addition of 144,000, which was the highest they've seen in the past 6 years. All of which was boosted by the pepperoni lockdowns, as people were forced to stay home and thus required internet to get anything done. That's not to say though that the pepperoni is actually helping Verizon. Instead, because the lockdowns have destroyed the economy, Verizon is experiencing far less media revenue, especially from advertising, which is leading to their sales dropping this year by around 3% before being expected to return to growth the year after. Still, Verizon is not really a growth type of company, But thanks to their dominance in wireless telco, profits continue to be very strong. According to Evercore Research, Verizon dominates the market at over 40% market share, which is double-digit percentage points higher than both AT&T and T-Mobile. Part of the reason why is thanks to their much higher network performance rankings, as well as the fact that they've built out such a large fiber network already that 5G will run on, which is only making it that much easier for them to expand it quickly. Even their faster 5G ultra wideband is scaling up at a very fast pace, as you can see on this chart here showing their progress year over year. Anyway, back to the profitability point, just like I've argued about AT&T, Verizon is able to generate tons of free cash flow every single year, with the past year alone seeing over $19 billion. That doesn't just allow them to invest in growth initiatives like 5G, but it also helps them pay a very nice dividend that even at today's higher prices that have already greatly recovered from the market lows in March and currently sit near an all-time high, Verizon is still yielding over 4% with a decent payout ratio and 13 years of consecutive growth to go along with it. AT&T still yields a lot more, which is why I prefer them myself, but Verizon arguably has a much more streamlined and focused business with also significantly less debt, although they are really both companies are highly leveraged. Either way, though, I just think Verizon is a solid dividend stock for the long term. And that dividend yield is already very attractive. But if the stock price was to come down and that dividend yield goes up to, say, 4.5%, 5% plus, that starts to get very attractive for that stock. And to tell you the truth, I'm actually thinking about picking up Verizon myself, even around these prices, just because I really want that dividend. I know I already own AT&T, but I wouldn't mind owning another play in this kind of market, diversifying a little bit there. And T-Mobile, there's not a lot of competitors left in the kind of wireless market. AT&T and Verizon would be kind of the leaders. I'd love to have those two. And T-Mobile just picked up Sprint. They just acquired Sprint, so that means even less competitors out there. So I would own two of the most dominant companies in this market. I wouldn't mind doing that. So I'm actually thinking about picking up Verizon. I'll have to update you guys on this one too, but it might be a stock that I'm buying sometime soon. I'll let you guys know. Anyway, those are the three stocks for this month's episode. I hope you guys enjoyed it. I'll leave a link down below to past episodes in case you want to check them out. But let me know if there's other stocks that are on your guys' radar that you've been thinking about buying. I'd love to hear what those are, and maybe I'll include them in a future video as well. I always take inspiration from comments that you guys leave. It's a fun thing for me to do. So anyway, thanks again for watching. I really appreciate it, and I'll catch you guys in the next one. Take care. Bye-bye.